In 1953, we created the 10-year Treasury. And in the 66 years from 1953 to the present, the yield curve was inverted on 22 quarters. And if we drill down a little bit further, we find out that 17 of the 22 inversions occurred between 1966 and 1981, and there were only 5 inversions in the other 51 years, in this total period.
Okay.
So the question then becomes what happened in 66 to 81 to create those inversions? And there were a bunch of things. There was, the Vietnam War was picked up. The Great Society program was put in place by President Johnson. The nation committed itself to building 26 million housing units over a 10-year period. A barrel of oil, which was $3 in 1966, was $36 in 1981. The Volcker situation developed, obviously, in 80 and 81 when, he closed the economy down. But the point is that it was an aberrational period in American history and in the American financial system. And therefore, to draw conclusions from that period and apply them to today is a stretch.
And there are plenty of people who are happy, Dick, to just look back and say, I'll just take the last time around. We had an inversion, then we had this event. So I'm just looking to this recent example. As you sort of answer that, explain why, and this is really where it matters most. You think the banks can make plenty of money in this kind of environment, even if the yield curve inversion happens again and happens persistently. Is that right? And does it matter which kind of banks?
Well, I mean, basically, facts have to matter at some point, right? In the period in which you had the 17 yield inversions from 1966 to 1981, bank earnings went up every year. They went up 16 years in a row. They went up through the 1973-75 recession. They went up in the beginning of the Volcker push. They went up in the recession that occurred in 1969. They went up in every year. So when someone gets up and says that an inversion in the yield curve, suggests that there's either going to be a recession or that there's going to be a problem with bank earnings, that's theory. It has nothing to do with fact. And that's the biggest problem in looking at bank stocks.
What happens, Dick, let me just cut to the chase of what the yield curve is worrying people about. I would assume that in a downturn, then you're talking about a real threat to bank earnings, to bank stock prices and so forth. Is the basic case that you're also making that you don't see that kind of slowdown coming?
There's no likelihood that the inversion of the yield curve that's occurring in this period, A, is similar to the ones that occurred in the prior period, or B, that it will lead to a recession. What is happening in this yield curve inversion is that you're getting a flow of money coming into the long end of the curve, pushing the long end down while the short end is held up by the Fed. What happened in every one of the other yield curve inversions going back, as I say, to 1953, is the short end of the curve went up because of either inflation or because of a strong economy. So whereas there was a shortage of funds that caused the inversions prior to this one, in this case, there's a surfeit of funds. And what does that mean? It means that this yield curve inversion is due to the fact that money is flowing into the U.S. economy, and that's not going to create a recession.